The first dollar is real. You can feel the weight of it. You earned it at 17, 4 hours behind a cash register on a Saturday, and you held it before you spent it. Because something in you understood even then that the moment between earning and spending was where the meaning lived. The dollar was proof. Proof that you had exchanged time for value, and the world had agreed with the exchange. That agreement, that simple bilateral contract between your labor and the market, was the only financial relationship you would ever have that was completely honest. Everything that comes after is a layer of abstraction built on top of that first exchange. The abstractions compound, the math gets larger, and somewhere in the compounding, the original dollar, the real one, the one with weight, stops being the point. You are 24, you have $11,000. It is in a savings account earning 0.4% annually. You have read 2 books about money this year. You have a spreadsheet with a tab called Net Worth that you update every Sunday. The number is small, but it is moving, and the direction matters more than the size. You understand compound interest in the way everyone understands it at 24. Intellectually, not physically. You have not yet felt it. You know the formula. You have not yet lived inside the output. The spreadsheet tells you that if you contribute $800 a month for 30 years at a 7% average return, the result is $1.1 million. You believe the spreadsheet. The spreadsheet is correct. What the spreadsheet cannot show you is what happens to the person doing the contributing over those 30 years. What the math assumes is that you remain constant, that your input stays stable, and your behavior stays rational, and your life cooperates with the model. The model is a graph. You are not a graph. That is the first thing the math cannot hold. You are 31. The $11,000 has become $140,000. You did not feel the compounding happen. It happened anyway. You have a 401k, a Roth IRA, and 4 index funds inside a taxable brokerage account. You have a mortgage. The mortgage reframed your understanding of debt in a way that no textbook managed. Debt is not the opposite of wealth. Debt is a tool with a cost. The cost is the interest rate. The tool either builds something or it doesn't. The mortgage builds equity. The equity builds net worth. You understand leverage now not as a concept, but as a lived structural reality. Every month, a portion of your payment chips away at principal, and a portion disappears into interest, and the ratio shifts slowly over time in your favor, and you feel the shift before the statement confirms it. That is what 31 feels like when the math is working. The math is working. You do not fully trust it yet. The 2008 collapse happened when you were 19, and the image of it is still somewhere in the background of every financial decision you make. You are 40. The brokerage account crossed $600,000 last spring. You did not celebrate. You recalibrated. The number changed the question from, how do I build this, to, how do I not lose this? The psychology of accumulation and the psychology of preservation are entirely different cognitive systems. Accumulation is forward-facing and tolerates risk because the future has time to correct errors. Preservation is backward-facing and does not tolerate risk because what you have took 20 years to build, and the market can erase a decade of contributions in 11 months, as it did in 2008 and as it did in 2020. You have restructured the portfolio twice since 40, not because the strategy changed, but because you changed. Your risk tolerance is not a fixed number. It is a function of your net worth, your age, your employment stability, your family obligations, and something harder to quantify, which is how it physically feels to watch your account drop $80,000 in a single week. Most financial models treat risk tolerance as an input. Most financial models are wrong about this. You are 49. The number is $2.1 million. You have crossed what some people call the first threshold, the point where the portfolio generates more in annual returns than your salary. At a 7% average return, $2.1 million produces $147,000 per year. Your salary is $130,000. The math has quietly overtaken the labor. This should feel like freedom. It feels like responsibility. The capital is working, but the capital requires management, and the management requires discipline, and discipline requires you to remain the same person who opened that first brokerage account at 24 and contributed $800 every month through 2 recessions, a divorce, a career change, and a year of medical expenses that were not in any spreadsheet. You are not the same person. Nobody is. The continuity of behavior across decades of life change is the actual challenge of long-term wealth building. The math assumes the person. The person is the variable nobody models. You are 57, and the number does not feel like a number anymore. It is $6, 4 million across 4 accounts, 2 real estate positions, a small equity stake in a business a former colleague runs, and a cash position that exists purely to prevent the worst behavioral error of all, which is being forced to sell assets at distressed prices because you have no liquidity. The math at this scale has stopped mattering in the original way. When the portfolio moves 1% in a day, the movement is $64,000. That is more than you earned in your first 2 years of work combined. The movement is abstract. It has to be abstract. If it were not abstract, the volatility would be psychologically unmanageable. You have learned to hold the number at arm's length, to interact with it as a system rather than as a pile of money. The moment you start thinking of it as money, the behavioral errors begin. You know this because you made 3 of them before you learned it. You are 63. The calculation has changed completely. You are no longer asking how the money grows. You are asking how the money lasts. The decumulation phase of wealth is mathematically simpler and psychologically harder than the accumulation phase. Accumulation has a clear direction, up. Decumulation requires managing a withdrawal rate against an unknown variable, which is how long you will live. The 4% rule says you can withdraw 4% of your portfolio annually with a high historical probability of the money outlasting a 30-year retirement. The rule is a historical average. History is not a guarantee. You have $8.2 million. 4% is $328,000 per year. You will spend approximately $180,000 per year. The surplus will compound. The math says you cannot run out. You do not fully believe the math. You did not fully believe the math at 24 either. This is the consistency that runs through every level. The math is correct, and the math is not enough. Something in the human relationship to money resists resolution at every scale. The anxiety does not scale down when the number scales up. The number changes. The anxiety restructures itself around the new number, and it continues. Now consider the other end. Not the careful accumulation over 40 years, but the institutional scale. A sovereign wealth fund with $900 billion in assets. A 1% daily move is $9 billion. The word billion has lost its meaning by the time anyone is managing amounts at this scale. It is a unit, the same way millimeter is a unit. You do not feel a millimeter. The people who manage capital at this scale have gone through the same abstraction process you went through between 11,000 and 8 million, except the abstraction has traveled so far from the original dollar that the original dollar is completely invisible. There is no memory of the cash register. There is no spreadsheet with a tab called net worth. There is an allocation framework and a risk committee and a mandate and a benchmark and a set of geopolitical relationships that determine which markets receive capital and which do not. The math is running. The math has been running for decades. The people running the math change every few years. The math continues without them. That is what $1 trillion looks like from the inside. Not freedom, not power in the way anyone imagines power. A permanent obligation to a system that existed before you arrived and will continue after you leave. The dollar was real once. One specific dollar, earned at a specific register on a specific Saturday, held briefly before it was spent. Everything since then has been a question of how far from that original exchange you are willing to travel and what you are willing to leave behind to get there. the math stops mattering. The distance is what matters. And the distance, once accumulated, does not return you to the beginning. It only continues forward.